Fee secrecy is a significant anti-competitive aspect of the U.S. syndicated loan market. This topic is presented by Thomas C. Willcox, attorney at law, a member of the Washington, D.C. and New York bars. The presentation explores how confidential fee arrangements among lenders can limit competition, potentially leading to higher costs and reduced transparency for borrowers. Welcome. Let's begin by exploring a financial market that plays a vital role in supporting large companies. Imagine a system where several banks join forces to provide substantial funding, sharing both the opportunity and the risk. However, when only a few lenders dominate, it can make borrowing more expensive and less flexible. Regulators should be stepping in to make sure the rules are fair and transparent for everyone involved. This presentation assumes that the reader has already reviewed Professor Bergqvist's comprehensive analysis of the EU syndicated loan market. We would like to extend our sincere thanks to Professor Bergqvist for his invaluable contributions and insights, which provide an essential foundation for understanding the comparative aspects of syndicated loans across jurisdictions. In this session, we'll take a closer look at how the U.S. syndicated loan market operates. We'll discuss its structure, the way transactions are handled, and the competitive landscape that shapes the experience for borrowers and lenders alike. Picture a scenario where a business needs a large sum of money, more than any single bank is willing to provide. Instead, a group of financial institutions collaborates, with one or more leading the process, to meet the borrower's needs. This approach is common for major corporate projects and expansions. Let's meet the main participants. On one side, you have organizations seeking funds. These can be corporations, investment firms, or even governments. On the other, there are banks that organize and manage the lending process, often joined by additional banks and investors who contribute to the funding pool. Let's take a closer look at the scale and dynamics of the U.S. syndicated loan market. In 2024, the total market size reached approximately $1.4 trillion, reflecting the immense volume of corporate borrowing facilitated by this system. What's notable is the dominance of a handful of major banks, forming a tight-knit group that shapes much of the activity in this space. This concentration means that a relatively small number of institutions have significant influence over lending terms and access. Another important feature is the existence of a secondary market, where portions of these loans are actively traded among participants. This allows lenders to manage risk and liquidity, while borrowers benefit from broader distribution of their debt. Understanding these structural elements is key to grasping how large-scale financing operates in the U.S. and why market power is concentrated among a select few players. This method of lending helps banks manage their exposure and allows companies to access larger amounts of capital. For borrowers, it streamlines the process, offering a single set of terms and a unified approach. The journey begins when a company seeks proposals from potential lenders and selects one or more primary agency banks to arrange the syndicate. After the initial agreement, detailed information is shared, and the agency banks parcel out the loan to a group of non-agency lending banks. The process concludes with formal contracts and the transfer of funds. Interestingly, U.S. authorities have not launched investigations into this market for anti-competitive behavior, unlike other financial sectors where regulatory actions are more common. Back in the mid-20th century, the current syndicated loan market didn't exist. However, a landmark legal case targeted major investment banks for their practices in related financial activities, setting important precedents. 17 prominent banks faced legal action, accused of working together in ways that limited competition and shaped the financial landscape for decades to come. The main allegations centered on exclusive arrangements, historical privileges, and reciprocal deals among banks, all of which could restrict fair competition. Additional concerns included fixing prices, dividing up lucrative business opportunities, and preventing outsiders from entering the market, as well as resisting rules that promoted open competition. Price-fixing allegations demonstrated that competitors allegedly coordinated on fee structures and pricing strategies, rather than competing independently to offer clients the most favorable rates. The division of business opportunities, whereby established players carved up market segments and agreed not to compete for each other's clients or territories, effectively eliminated price and service competition in specific sectors. This carve-up prevented smaller firms and new entrants from accessing those market segments, even if they could offer superior services at lower costs. The defendants further allegedly resisted regulatory reforms and industry standards designed to increase transparency and lower barriers to entry, using their collective market power to lobby against pro-competitive regulatory initiatives. The government in short alleged that the defendants, by actively opposing market opening reforms, the conspirators sought to preserve their entrenched competitive advantages and maintain the status quo that benefited the incumbent players, sharing sensitive information, balancing fees among themselves, and standardizing practices to control who could participate, sometimes using large groups to undermine competitive bidding. The sharing of sensitive competitive information, such as pricing data, client lists, bid amounts, and deal terms, eliminated the information asymmetries that normally drive independent competitive decision-making. By pooling this intelligence, competitors could coordinate their strategies and avoid bidding against each other aggressively. The practice of balancing fees among themselves represented a form of price coordination, whereby banks agreed to maintain parallel fee structures rather than competing on price to win business. Standardizing practices ostensibly justified as industry norms or best practices actually functioned as a mechanism to exclude firms that refused to adopt these uniform standards or that sought to innovate with alternative service models. The use of large groups or consortia to participate in bidding processes further undermined genuine competition by allowing the incumbent players to collectively set terms and conditions that favored their interests while disadvantaging independent competitors or smaller firms unable to meet the group's requirements. This consortium approach effectively transformed what should have been competitive bidding into a coordinated allocation process among preferred participants. In an opinion spanning over 200 pages, the Morgan Court did not find any unlawful activity in all of the government's allegations. Further, it did uphold the use of the syndicate system in the context of corporate borrower, reasoning that banks could not raise the sums of money at issue without spreading risk, for which the syndicate system was necessary. However, decades ago, the financial sector was less consolidated, with more independent firms and easier entry for newcomers. Today, the landscape is dominated by fewer, larger institutions. The syndicated loan market took off in the 1980s, driven by the need to finance big acquisitions and buyouts. This innovation allowed lenders to share risk and enabled larger, more complex deals. During this period, loans often covered a significant portion of buyout transactions, with multiple layers of debt and new financing structures making previously impossible deals achievable. Large syndicated loans are now concentrated among a few major banks, with higher barriers to entry and increased consolidation through mergers and acquisitions. When banks work together to provide substantial funding to organizations, several important documents are created to outline the terms and responsibilities. The initial paperwork sets out the basic conditions and is signed before the deal is finalized. These early agreements are typically kept private and are not shared with regulatory agencies, even though they contain critical details about the transaction. Once the deal is completed, the main contract, often called the credit agreement, is submitted to government authorities, such as the Securities and Exchange Commission. This document may mention the existence of earlier agreements, but the specific financial arrangements, especially those related to fees, remain undisclosed. In rare cases, such as when a company is facing financial distress, some preliminary documents might be made public. Even then, the sections detailing compensation for banks are usually withheld, with strict confidentiality clauses included to prevent disclosure of the underwriting fee. This approach to documentation means that while some information about the loan is available to the public, the most sensitive financial details are routinely kept out of public view. The agency banks receive special fees for arranging and underwriting loans, but these details are often kept secret, while other fees, most notably the interest rates charged by the lending banks, are publicly disclosed. Although regulations require disclosure of important agreements, in practice, certain fee details remain hidden, unlike the more transparent public bond market, where the underwriting fees must be disclosed as a matter of law. This secrecy makes it difficult for borrowers to compare underwriting fees or negotiate better deals, and competitors can't easily challenge fee levels. Confidentiality is a widespread industry norm, with banks insisting on secrecy and borrowers facing the finance industry's uniform claim such as a custom and practice, having little choice but to comply. Federal law requires public companies to disclose key agreements. While there are exceptions that allow certain details to be withheld, it appears as if the banks are able to induce the borrowers to withhold preliminary documents as a matter of custom and practice, raising questions about compliance. Antitrust rules prohibit unfair restrictions on competition. While joint ventures can have some limits, collective secrecy around fees may cross the line if it's not essential. Keeping fee information secret can suppress competition, make collusion easier, and isn't necessary for the functioning of loan syndicates. Borrowers may end up paying more, have less room to negotiate, and face a market dominated by a few powerful banks. Fee details only become public during legal disputes or bankruptcy, and reviews of filings show these documents are consistently omitted, with no proprietary information when revealed. Unlike syndicated loans, public bond offerings disclose underwriting fees, promoting competition and transparency in those markets. Some fees are tracked and published, helping negotiations, but arranger fees are excluded due to confidentiality, limiting market data and price discovery. Despite awareness of non-compliance, regulators have not enforced disclosure rules or challenged fee secrecy, and whistleblower reports have not led to action. Restrictions are only allowed if necessary for joint ventures. Keeping fees secret isn't required for syndicate operations, and case law suggests suppressing price information can be unlawful. If banks act together to keep fees confidential, it may be illegal. Courts have condemned such agreements, and there's no evidence that securities law overrides antitrust concerns. Research shows that when information is costly or hidden, prices tend to rise. Making some fees public has lowered costs, and keeping arranger fees secret likely has an even bigger impact. To improve transparency and competition, regulators should enforce disclosure rules, investigate collective secrecy, and encourage borrowers to advocate for openness. Compared to the U.S., the European market is more fragmented and competitive, with greater fee transparency and more active regulatory oversight, resulting in lower antitrust risks. In summary, the U.S. market's lack of transparency and widespread confidentiality practices likely increase costs and limit competition, highlighting the need for regulatory and antitrust intervention. For those interested in learning more, there are articles, regulatory guidelines, case law, and market data sources available for deeper exploration. Please note that if you use the link provided, you get a free copy of my article. Thank you for joining this session on the U.S. syndicated loan market. If you have any thoughts, questions, or would like to discuss any of the topics we covered today, I encourage you to reach out. Your feedback and inquiries are always welcome, and I'm happy to provide further information or clarification. Please don't hesitate to get in touch through the contact details provided. I look forward to continuing the conversation and supporting your understanding of this important area of finance. Thank you for joining this session on the U.S. syndicated loan market. If you have any thoughts, questions, or would like to discuss any of the topics we covered today, I encourage you to reach out. Your feedback and inquiries are always welcome, and I'm happy to provide further information or clarification. Please don't hesitate to get in touch through the contact details provided. I look forward to continuing the conversation and supporting your understanding of this important area of finance.